Hello everybody, this is Lara with your end of the week analysis for the S&P 500 for the trading week ending Friday 23rd of July. There is still a cluster of bearish signals from the AD line, so although price has made a new all-time high at the end of Friday's session, I am still going to expect that a consolidation will continue and it will be an expanded flat. There's still weak short-term bearish divergence between price and RSI as well. And so I expect that a minor degree fourth wave correction may continue lower and or sideways for another maybe 2 to 5 weeks. That may be a little bit optimistic though, maybe a shorter period of time. I'll expect support to be found about 4235 or 4137. I expect the upward swing within the consolidation could be complete at Friday's high or very soon. Next week I expect price to move lower. I do have an alternate that is more bullish though, looking at the pullback being over and the upward trend resuming. The next target would be 4922. At the weekly chart level, the Elliott Wave count expects that cycle wave 4 was over here and cycle 5 begins. Last week I had two alternate weekly charts. They were very bearish. They're both invalidated with a new all-time high this week. And so this is the only weekly chart left. Cycle wave 5 must subdivide at primary degree as a 5-wave motive structure, most likely an impulse, and within it, primary wave 1 may be incomplete, subdividing as an impulse, with intermediate 1, 2, intermediate 3 is extending, with minor 1, 2, 3, and 4 to continue. Minor 4 may not move into minor wave 1 price territory below 3950.43. Draw this best fit channel from the end of intermediate 1 to this high here, place a parallel copy on the end of intermediate 2. If we have a deeper, surprisingly deep pullback, then I would expect strong support at the lower edge of this channel. Eventually, when intermediate 3 is over and intermediate 4 arrives, it may not move into intermediate wave 1 price territory. Okay, let's take a look at the daily chart where this low for minor wave 2 down here is this point down here. Now here's the end of minor wave 3 and it's shorter than minor wave 1. There's a core Elliott wave rule that states wave 3 may not be the shortest. Sometimes that's misinterpreted to say wave 3 must be the longest. That's not what it says at all. Wave 3 may not be the shortest. It can be shorter than wave 1, but when it is, wave 5 is limited to no longer than equality in length with 3. In this instance, it would be wave 5 will be limited to no longer than 670.34 points in length. Minor wave 2 was a double zigzag lasting about 3 weeks. Minor wave 4 may be expected to exhibit alternation, most likely. It may be unfolding as an expanded flat. A, B, C. It may continue for another week or so for wave C to move at least slightly below the end of A to avoid a truncation. When I look at this piece of movement on the hourly chart, it looks like a double zigzag or single zigzag possibly, and I'm drawing a narrow channel around it. When that channel is breached by downward movement, then I'll have some confidence that minute wave B may be over and minute wave C may then be underway. And at that point, I'll use the Fibonacci ratio between A and C to calculate a target for minor wave 4 to end. So far, I'll only be saying we can expect minute C to move at least slightly below the end of A, and if it continues lower, I'll expect minor 4 to find support at the lower edge of this Elliott channel. Draw this channel with the first trend line from the end of minor wave 1, you can see where that is on the weekly chart, to this high here of minor 3, then place a parallel copy on the end of minor 2. Interestingly, it perfectly shows where this candlestick bounced up from support. So if minor wave 4 continues lower, I will expect it to find support at the lower edge of this channel, and it may not move into minor wave 1 price territory. For the very short term, when markets open on Monday, if minute B continues higher, I'll look for it to find resistance at the upper edge of this channel, so there's really not a lot of room for it to move into. At the hourly chart level, we're now looking at the structure of minor 4. Here's a double zigzag for minute A. This fits best now as a double zigzag for minute B, which is within the common range between 1 to 1.38 times the length of minute A. I think here minute B may be a 1.13 length of minute A. It's very close to resistance at the upper edge of that Elliott channel, so if it continues higher next week, look for resistance at this trend line. If we see this narrow channel containing minute B breached with clear downward movement, not sideways, it has to be downward movement. If that happens, then I'll have a bit of confidence that minute B may be over and minute C may then be underway. And then I'll calculate that target for minute C for you. But if price remains within this channel and continues higher, and especially if it breaks above resistance at this trend line next week, then seriously consider the alternate daily wave count. At the daily chart level, if we move the degree of labelling here within minor wave 3 or down 1 degree, it's possible that only minute 1 within minor 3 may be complete. It's possible minor wave 3 could reach its target of 1.618, the length of minor 1, at 4922. Minor wave 3 may only subdivide as an impulse. If within it minute 1 and 2 are over, then within minute 3 no second wave correction may move beyond its start below 4233.13. Let's have a look at classic analysis now. Let's have a look at classic analysis now and see how much support there is for the main or the alternate wave count. The main wave count bearish for the short term, bullish for the long term. The alternate wave count immediately bullish. There are now 3 examples of bearish engulfing candlestick patterns on this weekly chart, which were immediately followed by strong bullish candlestick patterns. We've got one here, and now here. So last week we had a bearish engulfing candlestick pattern, and the bearishness is now negated by a following upward week. Well, it's an outside week which has mostly got upward movement within it, and it's got a strong green close with closes near highs for the week, and volume is pushing price higher. Support remains about 4260. So the bearishness of these 3 candlestick patterns was not followed by any real downward movement. Well, this week slightly, but not really very much. On balance, volume has a new range, no signal this week. RSI has weak bearish divergence between these swing highs, this swing high here and this swing high here. There's a little bit of weak bearish divergence, which last week supported a bearish outlook for the short term. We got a little bit of downward movement, but really not much. There is still bearish divergence, but I'm learning that the best way to read divergence between price and RSI is to wait for the swing highs and price to form and then look to see if there is divergence between those swing highs in price and the corresponding points in RSI, rather than anticipating it. If I was to read bearish divergence here, I would be anticipating it. There's no formed high here for price. And if you look back at the history of price with RSI, if you anticipate that divergence like we could have back here, you could have anticipated it, but we didn't have a proper swing high from price, and price just continues on up and the divergence just weakens and weakens. It also needs to be close by highs, close by points, in order for it to be really considered to be a signal. That's how I'm learning how to read it. We've been over volume. ADX is declining this week, telling us there's no clear trend, but if it turns up again, it would tell us there's an upward trend again. MACD is bearish, and ATR is overall flat, which is normal behaviour for this market. The short-term picture sees a breakaway gap possibly, with price closing to new all-time highs, but it's doing so on light and declining volume. Well, not so light, but it is definitely declining volume. That could actually be sustained in current market conditions. If you look back at the history of this bull market from March 2009, that's a feature, rising price on declining volume. We had an 80% down day here, and then 2 back-to-back 80% up days. They're actually pretty close to 90% up days. This could support the view of a sustainable low in place. We do have new all-time highs, and it has support from on-balance volume, confirming new highs in price. And so that supports the alternate Elliott Wave count. And that's a good reason why I'm publishing for you, mostly these 80% down and 80% up days. However, Lowry's nearly 100-year history tell us that we really should be looking for indication of a sustainable low, a 90% down day followed by a 90% up day, or two back-to-back 80% up days. We don't have that, and so this signal is weaker, although here it did work. It could work again, and that's why I'm giving you that alternate wave count, but it is weaker and we do need to consider a more bearish scenario. ADX is still declining, no clear trend. ATR increases as price falls, normal behaviour. We've been over on balance volume. RSI is neutral. There is still bearish divergence, but we would be anticipating that if we look at it at this high. So I'm not going to do that. But at the last highs and last two peaks in price, there was very weak double bearish divergence. That supports the main Elliott Wave count, but not by much because that divergence is pretty weak. MACD is bearish still, and stochastics is entering overbought, but if ADX turns up, again indicating an upward trend, we'll use RSI, not stochastics. What about breadth and volatility? Because this is where we're really seeing bearishness. There's a small cluster now of 3 bearish signals at the weekly chart level from the AD line. This week, price makes new all-time highs. The AD line has failed to make corresponding highs. This upward movement in price does not come with a normal corresponding rise in market breadth. Upward movement has underlying weakness, and that supports the main Elliott Wave count, which expects a short-term consolidation to continue to relieve this weakness. At the daily chart level, there's really quite a strong cluster now of bearish divergence between price and the AD line. And Friday, prices made new all-time highs. The AD line's actually quite a way off. This bearish divergence is actually strong and offers good support to the main Elliott Wave count, and it's this chart right here which I'm giving quite a lot of weight to, and this chart is why that main wave count, despite a new all-time high for price on Friday, is still bearish for the short term. I have to take this into consideration. I have to give it weight because it's such a strong cluster. And this divergence is not weak at all. What about volatility? Well, again, we've got very long-term, long and mid and short-term bearish divergence now. Price moves up this week. Inverted VIX moves up as well, but it's quite a long way off its prior short-term high. This divergence is strong and supports the Elliott Wave, the main Elliott Wave count. No divergence for the short term between VIX and VVIX. At the daily chart level, we see it clearly as well here. New all-time high from price. Inverted VIX fails to make a corresponding high. Upward movement in price is not coming with a normal corresponding decline in VIX. VIX remains elevated. No short-term divergence. There may be a little bit of very weak short-term divergence, but it's so weak between VIX and VVIX, I won't note it. That's all for me at the end of the week with your S&P analysis. I hope that all of our members are well and happy.